A few months ago, a post on Reddit's dividend investing community went viral. One investor shared their entire portfolio, $2.26 million, built with just two ETFs, no stock picking, no market timing, no complicated strategy, just two boring funds and years of discipline. And the internet lost it. The post was picked up by Yahoo Finance, Moneywise, and a dozen other outlets. Everyone wanted to know the same thing. Which two ETFs? And could anyone actually replicate this? A quick disclaimer. I'm not a financial advisor, and this isn't financial advice. Always do your own research before making any investment decisions. Here's what makes this story so compelling. It's not that this investor found some hidden gem or made a lucky bet. They didn't trade options. They didn't flip crypto. They bought two funds and reinvested every single dividend for years. That's the entire strategy. And the two ETFs? The first one won't surprise you at all. SCHD, the Schwab US, our Dividend Equity ETF. It holds 101 high-quality dividend-paying companies: Coca-Cola, Merck, Chevron, Texas Instruments. The kind of stocks that quietly compound wealth while everyone else is chasing the next shiny thing. SCHD charges just 0.06% in fees. That's $6 a year on $10,000 invested. It yields about 3.3%, and here's the kicker. Its dividend has grown at roughly 11% per year over the last decade, and that means the income it pays you doesn't just sit there. It doubles every 6.5 years. Right now, SCHD is up nearly 16% in 2026. It's sitting at all-time highs, $85.9 billion in assets. This isn't some niche fund. It's one of the largest dividend ETFs on the planet. But SCHD alone doesn't get you to 2.26 million. Not easily, anyway. Because while its dividend growth is incredible, its current yield of 3.3% means you're not getting massive income today. You're building a machine that pays more and more over time. That's where the second ETF comes in. And this is the one that surprised a lot of people. DIVO, the Amplify CWP, Enhanced Dividend Income ETF. Most investors haven't even heard of it. But this fund is doing something different from what you might expect. DIVO holds about 25 high-quality stocks: Apple, Home Depot, Caterpillar, Goldman Sachs, Microsoft. But here's the twist. It also writes covered calls on 20 to 30% of those holdings. That options premium gets paid out to you as extra income. The result? A yield of 6.18%, nearly double what SCHD pays. And it pays monthly, not quarterly like most dividend ETFs. Every single month cash hits your account. Now you might be thinking, isn't that like JEPI or JEPQ? Those covered call funds that sacrifice growth for income? And here's the critical difference. JEPI and JEPQ write calls on nearly 100% of their portfolio. They cap almost all of your upside. DIVO only writes calls on 20 to 30%, which means 70 to 80% of the portfolio still captures full growth. And the numbers prove it. DIVO has returned nearly 13% per year over the last 5 years. That's not income sacrificing growth, that's income plus growth. Its total return has actually beaten SCHD over that same period. So why do these two work together? Think of it like this. SCHD is the growth engine. Low cost, rising dividends. Long-term compounding power. DIVO is the income engine. Higher yield, monthly payments, downside protection from those covered calls. Together, they cover each other's weakness. SCHD's low current yield gets boosted by DIVO's 6%. DIVO's flat dividend growth gets offset by SCHD's 11% annual increases. A 50-50 split between these two gives you a blended yield of about 4.74% on $2.26 million. That's $107,000 a year in dividend income. That's roughly $8,900 a month. Let me put that in perspective. The median U.S. household income, what most American families earn from working full-time, is about $80,600 a year. Cite this portfolio's dividend income alone exceeds that, without selling a single share, without working a single day. Now, most of us don't have 2.26 million sitting around. So let's talk about how Harry could actually replicate this. Harry starts today. He invests $500 a month, split between SCHD and DIVO. He reinvests every dividend, based on their historical returns, roughly 12% per year combined. Here's what happens. After 10 years, Harry has about $115,000, earning roughly $5,400 in annual dividends. After 20 years, $495,000, earning over $23,000 a year. And after 30 years, $1.75 million, earning nearly $83,000 in dividend income annually. To reach the full $2.26 million, Harry would need about 31 to 32 years at $500 a month. But here's the insane part. Over those 32 years, Harry contributes a total of $192,000 out of his own pocket. The rest, over $2 million, comes from market returns and reinvested dividends. His own money is less than 10% of the final portfolio. Compounding did 90% of the work. If Harry could invest $1,000 a month instead, he'd reach $2.26 million in about 26 years. $1,500 a month, 23 years. $2,000, about 21 years. The Reddit investor didn't do anything complicated. They didn't outsmart the market. They didn't have insider knowledge or a finance degree. They had two funds and the patience to let compounding work. And that's the real lesson here. The average retail investor holds 7 to 10 positions and still underperforms the market. This investor held 2. Fewer decisions means fewer mistakes. Fewer mistakes means better outcomes. Simplicity isn't a compromise. It's the edge. My 2026 has been a banner year for dividend investors so far. SCHD is at all-time highs. DIVO is quietly compounding, and somewhere on Reddit, that portfolio is probably worth even more now. If you want to see exactly how much SCHD you'd need to retire on dividends alone, with the real numbers and timeline, that video is right here. It might be the most important calculator you've ever seen.